Hi, Gary DeWaal here, and this is Bridging the Week, February 17th to 21st, and today is February 24th, 2014. Good morning. The default of a Korean broker in December 2013 related to its erroneous trading of certain derivatives is not new news, but the reverberations from this default continue to echo loudly worldwide. This is because the default raises two issues generating more and more attention: exchanges' error policies and their response after direct access members or their customers' algorithms go bad, and the authority of clearing members meaningfully to impact publicly traded clearinghouses when the firms are the principal guarantors of the clearinghouse's ability to deal with default situations. Again, this is an older matter, but we also have some more timely matters on this week's Bridging the Week. So, let's get started. In case you did not know, in December of last year, Hanmag Securities, a Korean exchange member, entered orders involving KOSPI 200 index options. However, apparently, because of a wrong variable in a trading algorithm, these orders were unintended. As a result, the firm sustained trading losses in excess of 46 billion Korean won, or over 43 million US dollars. At the time, the Korean exchange had no access to member kill switches and had no error policy that invalidated trades outside of a prescribed band. On January 3rd, the Korean exchange supposedly issued a notice to all of its members about this Hanmag matter, requested cooperation from counterparties in canceling the trades, and asked relevant counterparties to return the applicable proceeds. Apparently, a few counterparties complied with this request voluntarily, but the bulk of money remains unreturned outside of Korea, with the majority rumored to be in the United States. Hanmag's failure reverberated at the Korean exchange because the exchange covered from member guarantee fund deposits the amount Hanmag owed the Korean exchange, namely 57 billion Korean won, or over 54 million US dollars. The principal Korean financial services regulator, the Financial Supervisory Service, is said to be investigating this matter. On January 16th, the Financial Services Commission, the overseer of the Financial Supervisory Service, announced that by June 30th of this year, new regulations will be implemented that will give the Korean exchange the authority to cancel orders if the transactions are deemed to pose threats to the security of trading settlement, and that persons placing erroneous orders will be subject to punitive commission. The Financial Services Commission also plans to introduce price banding limits on futures and options trading, as well as to encourage securities firms voluntarily to enhance their internal control standards to preclude erroneous orders. Although not widely reported in the United States, this matter presents a real-life occurrence of two events that are especially worrisome: an algorithmic trading system gone bad, with an exchange having few effective tools to manage the problem, and a clearinghouse assessing clearing members as a result of the default of a fellow clearing member, over which only the exchange and local regulator had oversight, not the fellow clearing members. Without belaboring the point, it is critical by now for all exchanges worldwide to have transparent and predictable error policies with the ability to restrict access under certain circumstances. Also, given the prominent importance of clearing in the current derivatives financial model, there needs to be reflection whether there is an adequate and meaningful representation of brokers in the governance of central counterparty clearinghouses, now that most are demutualized publicly traded entities. Brokers, who are principally obligated financially to support the clearing process, may no longer have adequate input to protect themselves against fellow clearing member risks, now that the overwhelming majority of clearinghouses are publicly traded and not mutualized organizations. I'm not taking a view on any of this. I just think it's something important for all of us to be thinking about. The Board of Governors of the Federal Reserve System determined last week to impose a requirement on certain large foreign banking organizations to establish an intermediate holding company over their U.S. subsidiaries and to comply with the same risk-based and leveraged capital standards to which U.S. bank holding companies are now subject. These requirements were adopted among a host of liquidity, risk management, and capital measures adopted by the Fed to help increase the resiliency of the operations of both certain U.S. bank holding companies and foreign banking organizations. In general, the toughest requirements are imposed on domestic bank holding companies and foreign banking organizations with total consolidated assets of $50 billion or more. The objective of imposing these new requirements, claims the Fed, is to impose a quote-unquote level playing field and to, quote, bolster the capital liquidity positions of the U.S. operations, end of quotes, of foreign banking organizations. Foreign bank intermediate holding companies will now also be subject to Fed rules requiring regular capital plans and stress tests. The compliance date for U.S. bank holding companies with these new rules is January 1st of next year. Foreign banking organizations have until January 1st, 2016 to comply with the new requirements. Needless to say, non-U.S. banks and regulators, particularly in the European Union, are not happy. The European Banking Federation issued a statement last week condemning this Fed action, and according to Bloomberg News, the European Commission's financial commissioner, Michel Barnier, appeared to threaten express European Union retaliation. Oh boy, maybe Mark Weechin of the CFTC should be asked to sort this out. The U.S. Securities and Exchange Commission settled with Credit Suisse Group, and the firm admitted providing brokerage and advisory services for U.S. persons without being registered with the agency. This prohibited conduct occurred from at least 2002 through 2013, although the extent of the problem began reducing in 2008 when Credit Suisse began trying to eradicate its issues. During this time, U.S. persons were solicited, provided investment advice, and induced to engage in security transactions by non-U.S., non-registered relationship managers of Credit Suisse in the course of 107 trips to the U.S. Credit Suisse generated approximately $82 million of pre-tax income from its unlawful activities. For its violations, Credit Suisse agreed to disgorge profits and pay prejudgment interest and a fine totaling $196 million. They also agreed to retain an independent consultant to ensure the termination of the prohibited conduct. The SEC also announced that it is making a high priority this year to conduct examinations of investment advisors who have been registered for 3 or more years but never been examined before by the agency. The emphasis of the examinations will be to gain a high-level review of the advisor's overall business activities and to conduct a focus review on 1 or more high-risk areas. The European Securities and Markets Authority and the European Banking Authority concluded there has been significant progress in the Euribor benchmark setting process since the regulators published recommendations during January 2013. In case you don't know, Euribor is the money market rate for the euro, the currency of most states of the European Union, not the UK. 30 principally European-based banks contribute to the Euribor setting process each day. And finally, the People's Bank of China announced in late January that beginning July 1st of this year, certain RMB interest rate swaps of 5 years or shorter must be cleared through the Shanghai Clearinghouse. Non-clear trades will be reported to the People's Bank of China. Former CFTC Chairman Gary Gensler would be so proud. Well, that's it for this week's Bridging the Week. As always, there's more on each story and more stories on the article version of Bridging the Week on my website. Check it out. Until next week, have a great week, and this has been Gary DeWaal. Ciao.